What is going on, everyone? So welcome to another accounting video. This time we are doing budgeting, and I was just going to jump straight into budgeting, but I want to do a quick recap first. So with budgeting, we do make our reports, and we've done income statement a fair bit with the balance day adjustments. We've done the balance sheet a fair bit the whole way through, but now I think is now a good time to revisit cash flow statements. So let's just look at the three categories. Firstly, we've got the operating activities, and inflows are normally things like cash sales, receipts from accounts receivable, and GST received. Meanwhile, outflows will be stuff like payments to accounts payable, cash expenses like wages or rent that you actually pay, inventory purchased on cash, and GST paid. And then we get into the more nitty-gritty or the simplistic ones, our investing inflows. So our investing inflows are when we sell a non-current asset, so cash comes in. Our investing outflows when we buy a non-current asset. And now in financing inflows, which is capital contribution, and when we receive a loan, and our financing outflows, which is drawings and loan repayments. So I think the main thing to remember here is please remember, identify your investing inflows and outflows, so anything related to a non-current asset, and then your financing inflows, which would be capital contribution, loan received, and financing outflows, drawings, and loan repayments. If we look for those six transactions, the rest would be operating. We've already talked about this earlier on, but this is just your reminder. Now, the second one I want to talk about is cash versus profit, because as we know, not every cash inflow is a revenue, not every expense is a cash outflow. So we're going to end up with different numbers. We need to be able to explain why, whether it's an actual report or a budget. So firstly, let's do this. So we've got the revenues that are not a cash inflow. We've got credit sales, profit on disposal of asset, and inventory gain. These all, at the time they occur, make revenue go up and go profit, but aren't a cash inflow. Likewise, these expenses are not a cash outflow. They're cost of sales, inventory loss or inventory write-down, bad debt, depreciation. So these expenses occur, but are not a cash outflow. And then you've got cash outflows that are not an expense. That's stuff like drawings, buying a non-current asset, loan repayments, and GST paid. Likewise, you've got cash inflows that are not revenue, which is capital contributions, selling a non-current asset, loan received, and GST received. So we've got those items. We just need to be aware of those. Now, that is a small sample. There are more. Please be aware that there are more that you need to just be able to identify. But there is a very big overview. So the first thing I want to talk about with budgeting is, what is budgeting and why do we do this? So budgeting is the process of predicting and estimating the financial consequences of future events. So these future events are like given a set of scenario or set of circumstances and being able to budget it for it. And this will help us with decision making. And this leads into why exactly we're doing this, because it assists with planning and we can predict what is likely to occur. By predicting what is likely to occur, we can aid in decision making. We can provide ourselves a standard, and then we can ultimately make final decisions, whether it's to buy a non-current asset, whether it's a course of action or work. Regardless, this fulfills the qualitative characteristic of relevance and, by extension, timeliness. Now, relevance is easy because relevance aids with decision making, so you include the information. So we include the budget because it aids with decision making. Relevance is met, but timeliness is only met if we receive the budget at an appropriate time. Now, what's going to happen is you're going to be given a set of numbers and told, hey, make this budget. And it might be you're given flat numbers, you might be given information you need to calculate. You're going to be required to look at that and make your own decisions. Now, very much this is along the lines of what we do with additional information. So just be aware this will require reading. But essentially at the end of the process, you're going to do a report. It's going to be completing a report. And the first thing you may need to do is complete a receipt from accounts receivable and do that schedule, which I will show you in the example section. So we're going to be doing 2 examples. So when we do the report, we're actually going to be left with what is on the screen now. But we can see here we need to test the accuracy. So we need to test the accuracy of the income statement and the cash flow statement. And what we do is we do a variance report. And the variance report will look at the revenues, and for an income statement, look at the revenues, expenses, profit, and tell us, is this good or is this bad or favorable, unfavorable? And we'll do the same for the cash flow statement. So if we look at the income statement first, results will be considered favorable for revenue when the actual amount is higher than the budget amount. And that makes sense because if we predict 20,000 worth of sales and we make 30,000 amount worth of sales, then that's favorable. We've made more sales than we predicted. Hooray. But expenses, on the other hand, if our budgeted is higher than the actual, then that means technically we've gone under our expenses. So for example, if I budget 10,000 wages and only have 7, that's a good result because I've gone under. Of course, this is very contextual, so some close reading will be required. So for example, if cost of sales is favorable, it means you haven't sold as much. On the other hand, for the income statement, it's unfavorable if our revenue has a high budgeted amount than actual, and expenses, the actual is higher than the budgeted, because it means our revenue, we expected to make a certain number of sales, we didn't reach there, hence our budgeted is higher than the actual, and likewise expenses, we exceeded what we planned to use. So we used more than we thought. Now for the cash flow statement, a favorable view is for our inflows, the actual is higher than budgeted, while the outflows, the budget is higher than actual. So it's just we received more than we expected, or we spent less than expected for outflows. And then unfavorable for our cash flow statement, if the inflows are budgeted, what we expected to receive is higher than what we actually received, that's unfavorable, that's a bad result. Likewise for the cash flow statement, our outflows, our higher, we spent more, or the actual is higher than the budget of what we plan to spend. So that's how the reports look. But what else might we require to do? Now, I've already talked about completing the schedule of receipts from accounts receivable. Again, we're doing that as example 1. But example 2, the skill I want to show you is an account reconstruction. Now, an account reconstruction, just quickly, is you need to make a general ledger and fill in the gaps and find the missing amount. And that missing amount could come from a variety of items. So we might be doing accounts receivable, payable, inventory, GST accounts. It could be a variety of those. And then we need to calculate the cash we've received, we've paid, GST amounts, cost of sales, inventory, we've purchased. This could either be on credit or on cash, and build from there. And this helps us with our income statement, or it may link to another account. So it's a lot of world building. And again, we need close reading. I'm going to show you a very simplistic example so you can get the process down pat. But again, you'll need to know your debits and credits. So let's tick over to our example. So our first example will be Carl and Katz has provided the following set of numbers. And you see here, we've got the month of August, which is actual, and September, which is actual, all the way through December, which is budgeted. And those amounts for August is 8,000, September 9,000, October 10,000, November 11,000, and December 12,000. These are all dollar amounts. Additionally, we also know we have charged GST on top of these amounts, so these amounts are not including GST. And we also find out that we collect 70% the following month, so the month after, and then 30% the month after that first month. So if for example, August, we get 70% of that in September, and then the following 30% in October, and likewise. So we need to calculate, first of all, how much this total is, including GST, and what months we actually need to calculate, because we are required to calculate the amount received from accounts receivable during October, November, and December. So we're doing a 3-month budget. And you can see here we've expanded the table to include total including GST, plus the months we're calculating, denoted by month 2, month 1, in brackets underneath. So if it's month 2, we're just going to be multiplying that total included GST by 0.3. If it's month 1, it is by 0.7. And if we have a look here, we can see the full set of completed numbers below. So August sales, we actually collect 2,640 in October, and then October gets a month 1 of 6,930 from the September lot. And we can just go along and track that, and at the bottom we have our totals. So if we use October, for example, 11,000, we can see times 70% or 0.7, that will be 11,000 by 7,700, and then 11,000 times 30 or 0.3 will give us 3,300. And we can see here that if there is month 1 and month 2 in the same line, like in September and October, that it's going to add up to that total including GST as well. And most curiously, we see December, because the collection is going to happen in January, February, it's actually not included on here. So just another thing to be aware of there. So that's a general, quite simplistic version of the amount we receive from accounts receivable. If there's ever discount expense, you just deduct it from when it would be earned. So for example, if it was in October, you would deduct it from the 2,640 and carry on. We would do the same for accounts payable as well, but you would get that information. All right, let's start one of the more challenging aspects of Year 12 accounting, account reconstruction. So Carl's Cars is budgeting how much they will pay to their accounts payable, and they've provided the following estimates for the month of September. So they've given us the starting balance of 45,000. They earned a discount of 5,000. They've purchased 40,000 plus GST. They had a purchase return of 3,850 including GST, and they said that the amount they're going to owe at the end is 31,000. So essentially what we're doing is we're going to have an accounts payable ledger, and we're just filling in the gaps. But we need to calculate the bank. So we're going to put all our transactions in. So the first transaction, as you can already see on the screen, will be accounts payable 45,000 as the opening balance on the 1st of September. But then you're just going to work our way down. So we see we earned a discount revenue for the month. We put that on the 30th. Now, when you're recreating these and you put the dates in, I will recommend you just put the last day of the month in, just to keep it simple. You've then got purchased 40,000 plus GST. 40,000 plus GST will be 40,000 plus 4,000, which is 44,000. And that would go in the credit side because we're making it go up. We then see we've done a purchase return of 3,850. That will go on the debit side, and that is inventory / GST clearing 3,850. We then put in bank and then closing balance. So we leave bank blank, and you see balance 31,000. We also carry on and actually put that onto the other side. So we carry it forward to the 1st of October, which will be 31,000 on the credit side. We might as well skip ahead and do that. Now, what we're going to do is we're going to go by the biggest side. We're also going to use the side that doesn't have a gap in it. And we're going to see that the credit side is bigger anyway, totaling $99,000. So we put $99,000 on both sides, and we actually come out to make this account fully balanced, the bank will be 63650. The way we reach that number is 99,000 minus 31,000 minus 3850 minus 500, giving us the bank 63650. And that is the number, that bank 63650, that will go in the cash flow statement as an operating outflow. So just making sure we include that info. Now, in an exam, they will ask these type of questions. You will also be required to put an answer in a box. Please write the answer in the box, whether that is on the general ledger or in a box via calculation. So one more skill I think I want to encourage you to learn if you're watching this video is making sure you're able to just draw this up manually. By being able to draw this up manually, you can get yourself out of a few spots. You can also visualize things a bit easier, and it doesn't even need to be fully labeled. So that can go in calculation spaces, spare bits of paper, or even on the question book of your SAC or exam. Now, you don't have to follow these things. I'm just encouraging you. So my big bit of advice is for income statement or for budgeting, please read closely. When you are 100% done with the dot point, tick it off. So on that note, I wish you all the best. We've got 2 more videos left. We're going to be looking at profitability in one video, liquidity in the other, and I will see you next time. Be sure to like, share, and subscribe. See ya.